All right, so the markets rebounded quite a bit intraday and finished closing at the highs of the day, still inside of a very tight range over the past few weeks. We haven't quite broken out of yet. So we kind of got a little bit of a new high about a week or so ago, but we're still stuck, just really stuck in this tight range. So until we break out of that, we're just kind of noisy, and as noisy as you can be in a tight range, in a tight sideways range. And it's a pretty significant period of convergence that we're on. I'm going to explain what that is for those who don't know that term, and what it looks like on a chart, and what its significance is, and what's driving this action, and what has been driving the action for the past really couple of years, but even through the upswing that we ended the year on, and the previous downswing that we had before that. What are the main drivers of all that action? And then what do those main drivers look like now? What do they tell us about, which way we might break out of this little sideways trend? We'll take a look at what's driving this action from a sector standpoint. The sector rotation looks interesting, some interesting patterns there. And then our trade idea is a stock that kind of looks very similar to the Russell 2000, the chart that it's showing. So we'll talk about how to trade that given its pattern. So let's go ahead and get started. Today is Thursday, January the 18th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video over here. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button as well. Again, the more you do that, it helps get our content out to all of our followers on these platforms. Again, our goal is always to get to 100 likes on Twitter. So we're about halfway there. So for those who do like these day in and day out, thank you very much. It goes a long way. It's why we always ask for it. For those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicator like we always do. And you can see we rebounded off of a bearish near term, like again, bearish in the fact that it got into the bearish territory. Not, it didn't drop. It wasn't nearly as bearish as the last drop. It was actually at the lows of the day yesterday. It got down to those levels. But we rebounded off of the lows, and we jumped up today, and we've gone from bearish levels on the near term line to bullish levels in one day. So nice little rebound there. Of course, the momentum line didn't jump up too high. So as of right now, we wouldn't expect an extended near term run, right? The probabilities of an extended near term run where again, the typical time frame between low to low is 7 to 12 days on a bullish trend. So the odds of being longer in that range go up when the momentum line starts it with a strong momentum move to the upside. Not the case yet. We're only 1.5%. We're not above. We're not above the 2.5% mark. So we're kind of in this kind of quasi bullish, but not really bullish zone right here in the envelope around that 30-day moving average. And you can kind of see just visually the convergence going on, right? We extended away from the moving average with a lot of momentum, and then now we've stayed above it, but the gap between the two lines, the close of the S&P and the 30-day moving average just gets smaller and smaller. That's convergence. That's a visual representation of what convergence is. Now it's not consolidation, right? That's when the intermediate line actually drops in the bearish territory, like this or like this over here, and that hasn't happened yet, obviously, as we head into options expiration here tomorrow, the January options expiration. If we take a look at let's take a look first before we go to the other charts. Let's take a look at the NASDAQ 100. Again, this is kind of the big reason why we've been so bullish here lately. Its momentum line did jump up to extreme highs, so we do have. But on one hand, on the other hand, the near term line never did drop to bearish levels. So it's actually we're still on the same near term run that you can see. And if I were to take these off, you can see it a little bit better. Lots of drawings going on here. There we go. So now you can see the lines a little bit better there. If you take a look at the Dow Jones Industrial Average, right, it's really been in convergence mode. I'm going to get rid of these lines too. It has really been. And you notice here, coming off of this retracement, as we bounce back up, you see where we're hitting the 162% retracement as resistance up to the upside. And big time convergence. The gap has shrunk completely on where the price is relative to the 30-day average. The intermediate line has crossed below market sentiment with the market sentiment line above the 90th percentile. It is rare to get the market sentiment line above the 90th percentile, and yet there it is. That's just how bullish the Dow Jones Industrial Average has been. And then finally, let's take a look at the Russell 2000. Whoops. And you notice, again, we just got a bull tag today. So the Russell 2000, which, remember the S&P got that, or never got the pink shading a week or so ago. The NASDAQ 100 did get a bull tag back then. The Dow Jones Industrial Average has been so bullish that it hasn't been close. The Russell has been so bearish, a lot more bearish than the S&P during this decline. But it was so far above the moving average that it's taken that much of a decline just to get to the bull tag. And then, of course, you can see, the move we've had since then, the last few days. But you also notice that we have shifted from light pink shading to dark pink shading as the intermediate line has crossed into the lower half of the chart, well below market sentiment, into the lower half of the chart. Now, the near-term line made a run above the intermediate line last week, and it failed and did not get into the upper reversal zone. You can see how the momentum line didn't help. And now here they are both still below the intermediate line. And we'll see if we follow through with today's little rally, late intraday rally, and follow through with that with the near-term line crossing above. That would be a bullish crossover if the blue line crosses up above the green line there. If we take a look at the weekly chart, you can notice again, still got the transition candle, very small body, very small range. And you can see that we're still pretty high, about as high as we got last time, above the gap between the 10 and the 40-week moving averages there. The gap for the Dow has really gone. I mean, look how big the candles were for the Dow, and it's below its average. As we've been getting nothing but transition candles there. The Russell 2000 is a little bit of a different story, right? It's in bearish mode, right? So this is actually a pretty decently bearish candle that we've gotten here. As we're flirting with getting a red arrow cross below. In fact, we did actually get it earlier today, the cross below the 10-week moving average. We had the transition, and then we've transitioned from bullish to bearish with it, like I said, a pretty decent sized candle to the downside. Of course, your NASDAQ is essentially a carbon copy of what the S&P 500, a little bit more bullish as we don't have a lower shadow on this week's candle, and it's above its moving average in terms of the size of that bullish body there. From a 3 green arrow perspective, you see we have 2 red arrows on the S&P. We have 3 greens on the Qs. So that, again, this shows how more bullish the Qs are. This is a QQQ. It's a Magnificent 7 world that we're living in here, because you can see the Russell still has 3 red arrows, continues to have 3 red arrows. So big difference between the 2 major indexes, between the mega cap index, which is pretty much 50% made up of 7 companies, and then the small cap index, which has no influence at all from those, at least directly from those 7 companies. And then your Dow, which has been in convergence mode, and you can see it even more on this average. You can see how the MACD has been below its moving average. Again, that's convergence mode, almost crossing below the stochastics moving average there. We're starting to converge with these other long-term averages. Big gap between the 30 and the 200-day moving average. Diamonds have even a bigger gap between the 30 and 200. That is not very pretty, right? And you can look at how big the convergence has been on the Dow Jones. And then finally, your Russell 2000 is clearly broken through. And again, when you break through the 30, break below the 30, you tend to fill in towards the 200. That's when you get pullbacks. That's generally the start of a pullback, when you get those 3 red arrows, but we don't bounce, right? You get 3 red arrows and you bounce, you're okay. You get 3 red arrows and you don't, you tend to fill it in towards the 200. And the gap's a little bit bigger, and it's, we're in that mode. It's holding the 50 so far. The 50 is usually in between there somewhere, and it tends to hold it briefly when you get to the 50. And then, that's kind of the first stage, and the second stage is when it breaks the 50 and makes its way to the 200. You can see the MACD itself is in negative levels. It's crossed below 0 down there. Looking at some of the other oscillators, we have a rebound on the DMI positive indicator back above 25. the negative indicator working its way back lower. Not the case for IWM. The negative actually still is above 25. The positive is not below 20 yet. The Dow is still, I mean, the Dow's ADX is still above 40. That goes to show just how insanely bullish it got, because the ADX got above 60. And then again, how very weak the trend is. Like, both lines are barely, like, the positive indicator is barely above 20. They're both easily below 25. The negative is still, it can't get going, right? Can't get above 20 at all. Looking at the RSI and the CCI, you're still at bullish levels. You rebounded back above 60 there, so you're still at bullish levels on the RSI, and you're still above in the upper half of the chart here on the CCI. On the weekly chart for that CCI, we're falling, but we're not necessarily falling at, a sharp level at all here. We're still pretty bullish there, and the RSI, you can see again, has not fallen to bearish levels either. Again, a distinction with the Russell, because we have fallen to the lower half of the chart on the RSI, and we are below minus 100 on the CCI, and working our way a lot lower on the weekly CCI. The Dow Jones still has a very strong RSI and CCI on the weekly chart, even if its CCI dropped down to pretty low levels yesterday, and you're not below 50 yet, but you were so far up above. You had gotten up to almost 90 here that you had dropped below 60, so you're just not at bullish levels anymore. If you take a look at the Ichimoku cloud, again, we still have very strong trend strength on the S&P, where the rate of change is still very high, right? Very, very high. Now you notice we're running into an area where it's not going to be very high, right? That's on the S&P. The Dow Jones is the same thing, kind of looks the same way. But if you look at the small cap index, we are below the blue line, filling in the gap between the blue line and the gap, the cloud. The rate of change is positive, but I mean, unless we get a significant move to the upside, it's going to turn negative here. And you can see here too that we have a weak bearish trend. So we're below -1 and we're above 50. And so the next stage would be to get below -2 and be above 65. And we're not quite there yet on that one. And then finally, let's take a look at the Bollinger Bands and the Keltner channels. And you notice the bandwidth, again, remains extremely low, though we are back in the upper quartile of the bandwidth. Very, very low bandwidth, that is. Easily inside the Keltner channels, hence the red dots. And you notice we haven't changed the momentum yet. We're still slightly positive in momentum. We haven't changed it yet to the other side. IWM has pretty clearly changed it. I mean, that's a pretty decently bearish momentum there. We are not below the lower Keltner channels, so the bands did expand back outside. After one day of it being inside, they did expand back outside. And you notice that the bandwidth is starting to increase again because the move, at least the last couple of days, into the lowest quartile of the bandwidth. Now we're just towards the lower third of it, but still in the lower half, right? We're still in that lower half of the bandwidth, trying to get back into the value area where the point of control now exerts its influence when you're in the value area there. The stochastics, you can see, we had dipped below the lower half of the 4-week range. Now we're back into above the 80th percentile, so that's relatively bullish, and back above the moving average. So we had a surge before. There's that surge again. In the Russell 2000 is much different. We're in the lowest quintile of the bandwidth. We didn't quite get to a new 4-week low point, I don't believe. I'll have to take a look at it here. But you can kind of see how bearish that is. Its average is really falling down. You also see the difference on the hull. The hull is still holding up there. We're still below the moving average. It's a small candle, but it's still holding up positive. Green on the hull, parabolic SARs to the downside. Again, not the case for IWM. Red line on the hull, parabolic SARs to the upside, easily below the moving average. Still not negative though. That's when things really get bearish, is when you go negative here, and we haven't. So we're actually still okay from that perspective, though we still have some bearish candles here on the downside. Let's take a look at today's intraday range. Again, no new high, no new low. The range is still extremely small, as you can see down here. And again, we'll see if we get a new high tomorrow. It'd be nice to be able to get this green line back up to 100, without dropping below 70. We've already had one kind of false dip below 70 here. You don't get very many. You might get one, you might get two. You kind of got two there, but then when you dip, that's when things turn around. So we'll keep an eye on that. As the ranges today and the volume was really light, very slightly above average range, not including the gap because the gap got filled in, and slightly above average on the volume. But you notice both of those are relatively small numbers. I mean, we're still way below 1% on the ATR, and the volume is at probably the lowest third of its 52-week range. That average volume has been. Volatility, which had jumped up yesterday, we talked about that in our Market Scholars class, came back down below 15 today, still hovering right around that 90% mark, which is acting as resistance. And your VVIX, which had gone from an extreme low that we talked about, is typically precedes a jump in volatility. It jumped up so much, but now has pulled itself back below 90, at least at 86. And we'll see if it continues to move lower. You're positively correlated right now between the VVIX and the VIX, and it appears to be that the VIX is trying to change its momentum right now from being negative to being more positive. It got up to its 200-day average yesterday, and still is above some of these other average values from differing time lengths there. All right, now let's take a look at what's driving a lot of this price action. So let me bring up the asset comparison chart here. And you can see the three month returns, but let's just look at today first alone. And you'll notice the Qs, again, the big mover higher. IWM rallied, but again, to a lesser degree. In fact, it was down early before rallying here late to a gain. So even at pretty much the Qs were up all day long. The S&P was up all day long, but that wasn't the case for the Russell. The Russell at one point was down 0.5%. Real estate stocks are down quite a bit. Bonds were down. So it's kind of nice to see stocks do so well with yields jumping up as much as they did today. Yields jumping up to 4.14%, and not above the 200-day moving average. MACD is positive down there. Not quite above that 50 yet, kind of the last bastion here. But if it does get above that 50, now we're looking, as you can see, when you get above all these moving averages here, there's not a whole lot to keep it down from coming lower. And that's, as of right now, you're above the 8 and 17. The 8 and 17 themselves are above the 30, but you're just inside the gap between 30 and 50, and that's the last. So get above 4.2%, then things can get pretty dicey, as we've seen for equities, because the equities don't like those that move higher in yields. The dollar is at the same kind of level, right? It's at its 200-day moving average as well as the 50, kind of in between a gap there. The 8 and 17 are also above the 30. And again, it's a matter of, do we break out above 103 and start moving up towards some of these other Fibonacci levels, which again has not been bullish for equities in the past. And then finally, looking at commodities. Commodities have fallen way below the 200-day moving average, but have been in big-time convergence mode and rallied up here today. Crude oil, of course, kind of the bellwether of that space, sitting right on this point of control above its 30-day moving average. 8 and 17 are above it. We've got a positive MACD. It's looking to make a run towards. And again, I mean, it's pretty much closely tied in to inflation expectations. Energy prices are. And they've been so bearish for the good chunk of time here over the last part of the year. But look at gasoline making its way up above. And that's just that. This is the time of year for gasoline and crude oil to make a run higher, right? The first half of the year it makes a run higher. The second half of the year it makes a run lower. It's just a matter of how much up or down it goes at that point. And right now you can kind of see the yields are the same way. Yields tends to move higher into the middle of the year, and then is lower by the end of the year. And then finally the dollar also makes a run towards the beginning of the year, and it has one kind of big drop in the middle before another late run at the end of the year the dollar typically makes. So right now we're on a pretty decent run early in the year, and we're about to head into a seasonal time of year in February where the dollar typically makes a really good run before a little bit of a pause in May and April. So how during this little run that we're on, the seasonal rally that it tends to get, how far up will it go? Will it be able to change the trend, or is this the extent of the early year seasonality of this. I don't think that's the case. I think there's, again, we'll probably end up kind of in this area by the time we're done with the seasonal bullishness through the next month. And again, the markets haven't liked that. That's the three-headed monster. Rising yields, rising dollar, rising commodities have been bearish for equities in the past. You can see from this, when did the S&P peak? It was like October, or bottomed out on October the 30th, 27th. So from October 30th on, if you take a look at that comparison chart from October the 30th on here, going back to 2023, you can see that it's, commodities were down, the dollar was down, and bonds were up, and that's been really bullish for equities going into from August the 1st of 2023 into that October the 27th, the last day the last oversold cluster we got on the S&P 500. You can see here the dollar was up, commodities were outperforming. They were up slightly, but outperforming everything else. And then you can see bonds were way down, so yields were way up. So you see how those three are pretty much the big drivers right now, and they're all kind of bouncing, and they're all right around. At least the dollar and the yields were right around this 200-day moving average, and they're 50. And again, a break above those, that gives it some some headroom to go up further. And commodities. Once they break that 30-day moving average, remember when you break the 30-day moving average, you tend to fill in the gap to the 200. Once you break its 30-day moving average, there's a pretty sizable gap that it can fill in pretty easily during its seasonal run at this early time of year. Let's take a look at the sector rotation. Of course, you can probably guess what had the best performance here today. It has been the best performance of the year so far. If I just take a look at like the 5-minute chart here, XLK was your big winner, up 2% today. XLC was up 1.25. Again, it's all like Nvidia, especially doing very well. XLY, you can see. Is underperforming the S&P. Industrials was actually a big performer to the upside. Utilities and real estate, rate-sensitive sectors, energy, dollar-sensitive sectors, all down here, lagging behind. If I take a look at the 12 grid for all those charts, you can kind of see which ones are matching the market right now, like the XOK. XLC kind of look exactly like the market. Everything else is in various degrees of weakness. XLY has got dark pink shading and a yellow line. XLB has dark pink shading and a red line, along with energy prices. You're starting to get some weakness on industrials, but we'll see how temporary, whether that bull tag is temporary or not. And you don't quite have the bull tag yet on financials. Healthcare staples, safety trades are actually holding up better, which is not necessarily what you want to be the ones holding up better. Utilities forming a cluster, dark pink shading and a red line, and then you've got the bull tag on real estate as well. So you see, again, varying degrees of weakness cropping up as the market itself is converging in this convergence mode. All right, our trade idea of the day is on Zillow. If you take a look at Zillow here, it kind of looks like the Russell 2000 got way up above, very, very late in the year rally, up to a very parabolic level. It's pulled back to the moving average. Got the bull tag a few days ago. Bounced up a couple of times here today. The near-term line still below its intermediate line, and the intermediate line now just crossing below market sentiment. So not the best picture, as you can see, after some strong candles to the upside. Very, very strong candles, the strongest candles that we've seen since back over here. But just like that was kind of an exhaustion move, you wonder how much of an exhaustion move this has been now that you're already showing some pretty bearish candle, a bearish transition, and then some bearish candles here to the downside. If you look at the 2-line version of this chart, right here, you'll notice that, again, you're below the 30-day moving average. The 8 and 17-day are also below its average. And you can kind of see where, this 47.5 level, where the 200-day moving average is. Remember, there's a good chance, not 100%, but a good chance that once you start to break the 30, you make your way to the 200-day moving average, especially when you're kind of this close. MACD has gone negative below its average there. If you take a look at some of the other oscillators on this chart, the DMI, you can see we were a positive trend. Now the negative indicators cross back above that ADX there. The RSI and the CCI, are also showing pretty bearish levels below 50, well below zero, and getting below that minus 100 mark on the CCI. Looking at the Ichimoku cloud, you have broken below that blue line, kind of holding it a little bit, but you can see where the rest of the cloud is. Whatever bullish trend we had is gone on that chart. And then again, that Bollinger Bandwidth, which had really widened out big time, has come back down to low levels. And now we're in the lower half of the bandwidth as we've alternated to some bearish momentum. We had, again, very similar to IWM, where you've moved into the range, the bands moved into the Keltner channel, and then popped back out with a move to the downside. So I wanted to do a bearish trade, but not be so aggressive. So we're going to buy the at the money option and then sell the 50. Remember the 50 is right up in this area, so pretty much the lows. And then we have that 200-day moving average down to about 47.50. So it gives us a lot of flexibility to work with on this trade from a timing perspective. That's how much room it has to go. And again, position sizing for very low risk, right? When you compare this like a bear call spread, I'm using half the risk to get a little bit more reward than normal. So a little bit lower probability, but I'm compensated for that with lower risk and a higher reward for my risk. Because again, if I were putting that same $1,000 at risk, I'd be getting $1,400 instead of just $300. So I'm compensated for the risk I'm taking, and I'm also compensated for the lower probability that I'm getting. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Thursday night, everyone, and we'll see you all next time.